Everyone, we got a pretty huge filing out of the OCC, Options Clearing Corporation. Now this is in regards to variations and implied volatility. So this is pretty huge. So let's go ahead and take a look at this. There's two main things you're going to be doing in here. They're going to be revising their futures model, and they're going to be revising their implied volatility risk model for the OCC. Let's go ahead and take a look real quick. And group members, pay attention because this is super important. And this is why we read filings that are relevant. So OCC-2022-801. This was filed on the 7th, and it's scheduled to be published on the Fed Register on the 11th, tomorrow. Now, this is not filed immediately. This is just an advance notice. This may take some time here. Options Clearing Corporation's margin methodology is going to be looked at in regards to incorporating variations and implied volatility. So, real quick, clearing agency statement of the terms of substance of the advance notice. This advance notice is submitted in connection with the proposal to simplify OCC's margin methodology, the system for theoretical analysis and numerical simulations, or STANS, control pro-cyclicality and volatility modeling, provided natural offsets for volatility products with similar characteristics, and build the foundation for a single consistent framework to model equity volatility products in margin and stress testing. Specifically, this proposed change would: number one, implement a new model for incorporating variations and implied volatility with STANS for products based on the S&P 500 index. That should start ringing a bell to the group. This is based on the S&P 500 index. Such index hereinafter referred to as the S&P 500, and such proposed model being the S&P 500 implied volatility simulation model, to provide consistent and smooth simulated volatility scenarios. Number two, to implement a new model to calculate the theoretical value of futures on indexes designed to measure volatilities implied by prices of options on a particular underlying index, such indexes being volatility indexes like your VIX, things like that. Number three, we have replace OCC's model to calculate the theoretical values of exchange-traded futures contracts based on the expected realized variance of underlying interest, or such contracts being variance futures, and such model being the variance futures model, with one that provides adequate margin coverage while providing offsets for hedged positions in the listed options market. We're going to be only looking at number one in this video right now, but I thought this one here is pretty interesting. So, current implied volatilities scenarios model. I guarantee you most of the members here didn't know that this even existed. This is how you learn what they do. And looky here. We use this to price our options for one reason. It's what the industry uses, so we're both using the same thing. Now, generally speaking, the implied volatility of an option is a measure of the expected future volatility of the option's underlying security at expiration, which is reflected in the current options premium in the market. Using the Black-Scholes options pricing model, the implied volatility is the standard deviation of the underlying asset price necessary to arrive at the market price of an option of a given strike, time to maturity, underlying asset price, and the current discount interest rate. In effect, the implied volatility is responsible for that portion of the premium that cannot be explained by the current intrinsic value of the option, i.e., the difference between the price of the underlying and the exercise price of the option, discounted to reflect its time value. OCC considers variations in implied volatility within STANS to ensure that the anticipated cost of liquidating options in an account recognizes the possibility that the implied volatility could change during the 2 business day liquidation time horizon and lead to corresponding changes in the market prices of the options. Using its current implied volatility scenarios model, OCC models the variations in implied volatility used to reprice options with STANS for substantially all options contracts available to be cleared by OCC that have a residual tenor of less than 3 years, or shorter tenor options. Now, the word tenor, that's just a fancy way of saying an option is the amount of time remaining to its expiration. That's what tenor means. It's amount of time remaining to expiration. Whenever you hear the word tenor, that's all that means. They like to make up fancy words in finance. Now, to address variations in implied volatility, OCC models a volatility surface for shorter tenor options by incorporating certain risk factors, for example, implied volatility pivot points, based on a range of tenors and option deltas, into the model and stands. Now, a volatility surface refers to a three-dimensional graphed surface that represents the implied volatility for possible tenors of the option and the implied volatility of the option over those tenors for the possible levels of moneyness of the option. Remember, we just went over moneyness the other day. Moneyness means, you're in the money, at the money, and out of the money. Those are your three types of moneyness. I guess they go ahead and explain it here to you. The term moneyness refers to the relationship between the current market price of the underlying interest and the exercise price. And delta of an option represents the sensitivity of the option price with respect to the price of the underlying security. So, currently, these implied volatility pivot points consist of 3 tenors of 1 month, 3 months, and 1 year, and 3 deltas of 0.25, 0.5, and 0.75, resulting in 9 implied volatility risk factors. These pivot points are chosen such that their combination allows the model to capture changes in level skew, convexity, and term structure of the implied volatility surface. Now, Supernote 16, and this is what I've been trying to say, if you're not getting with the program and you're a trader with this data, you're getting left behind. They're not charting TA anymore. They're not drawing triangles, bullish pennants. That is a thing of the past. It's all about data visualization and simulation. So Supernote 16, stands relies on 10,000 price simulation scenarios that are based generally on a historical data period of 500 business days, which are updated daily to keep model results from becoming stale. That's daily updated 10,000 scenarios over a period of 500 business days. So I'm telling you, the shit's nuts, and it's easy to get all this data now. With the birth of APIs, easily accessible, it's all out there, and it's available to get. Supernote 19, a quality that is positively correlated with the overall state of the market is deemed to be pro-cyclical. While margin requirements from risk-based margin models normally fluctuate with market volatility, a margin model can be pro-cyclical if it overreacts to market conditions, such as generating drastic spikes in margin requirements in response to jumps in market volatility. Anti-pro-cyclical features in a model are measures intended to prevent risk-based models from fluctuating too drastically in response to changing market conditions. Changing market conditions and options, huh? Wonder where that could be going. Now, to reduce the oversensitivity of the implied volatility scenarios model to large sudden shocks in market volatility and therefore result in margin requirements that are more stable and that remain commensurate with the risk presented during periods of sudden, extreme volatility, OCC modified the implied volatility scenario model to use an exceptionally weighted moving average of forecasted volatilities over a specified look-back period rather than using raw daily forecasted volatilities. Now, an exponentially weighted moving average is a statistical method that averages data in a way that gives more weight to the most recent observations using an exponential scheme. The current model uses the nearest neighbor method to switch pivot points in the implied volatility surface, which introduces discontinuity in the implied volatility curve for a given tenor. In addition, the implied volatility scenarios for call and put options with the same tenor and strike price are not equal. These issues introduce inconsistencies in implied volatility scenarios. Due to the use of arithmetic implied volatility returns in the current model, it can produce near zero implied volatility, which we have seen. We've caught this shit. So now you see they are writing fixes for the shit that we've seen. So as long as we continue to use our eyes and navigate the market in real time using our eyes and data, we're going to be just fine. By the way, due to the use of arithmetic again, it can produce near zero implied volatility, which is unrealistic in a few simulated scenarios. Out of those 10,000 simulated scenarios, just a few of them had this happen, which we're now trading off of. You should feel good about that. Anyways, how about them apples?